Hey everyone, and welcome back to the Investor's Brief. Have you ever wondered why some people, like Warren Buffett, build multi-generational fortunes, while others treat the stock market like a casino and seem to lose everything? If you're someone who genuinely cares about building a solid portfolio and making smart investments based on real facts, not just marketing hype, then you absolutely need to hit that subscribe button right now. It's actually shocking that over 95% of viewers don't subscribe, despite saving hundreds, even thousands of dollars from the information in these videos. Subscribing costs you nothing, but it helps us keep bringing you content that many financial advisors just don't want you to see. In this video, you're going to get a crystal clear understanding of how the stock market actually works, how people genuinely make money in it, and the powerful tools you can use to start investing with confidence, even if you're just starting with, say, 50 or even 100 bucks. We'll also dive into the proper way to invest, so you can give yourself the absolute best chance of making money. So, grab a notebook, feel free to pause and rewatch, and stick around through this entire guide. Ready? Let's dive straight into why investing in the stock market is so crucial. First off, let's talk about the S&P 500. This isn't just a fancy name. It is a stock market index that tracks the top 500 U.S. companies and is considered the best representation of the U.S. stock market. And here's the best part. The S&P 500 has been consistently trending upward, producing an average annualized return of about 8 to 10% per year since it started. That's a tried and true method for growing your wealth over time. Plus, it's surprisingly simple to do, especially if you just buy the entire index, which we'll cover later. The second big reason you want to invest in the stock market is that historically, stocks have actually produced the best returns over the past 100 years compared to pretty much any other asset out there. I love this short video by Max Klemenko, where he quizzes Wall Street pros on the top 10 investments of the last century. Guess what's number 1? Stocks. With a 5.2% real average annual return, significantly outperforming treasury bonds, fine art, precious metals like gold, and even real estate, which comes in at number 10 with just 0.3%. Over the long term, stocks have the most potential to truly transform your life through capital gains. Every single high net worth individual I've interviewed, people talking 9 figures and above, agrees. To build serious wealth, you need to concentrate your money into appreciating assets. And that brings me to reason number 3. You want your money to work for you. Having cash just sitting in the bank doesn't offer much return anymore. Your typical big bank like Chase or Wells Fargo might give you a paltry 0.1%, maybe 0.15% in your savings account. Let's pretend someone hypothetically gave you $1 million and you wanted to live off that for the rest of your life. If you put it all into a Chase savings account paying 0.01%, you'd earn a grand total of $100 in an entire year. Your $1 million isn't working hard for you there. Now imagine that same $1 million earning 10%. That's $100,000 per year. That totally changes things, right? Even at 5%, that's $50,000 annually. The magic of investing is letting your money work for you and compound over time. Finally, the fourth reason you absolutely need to invest in the stock market is simply because of inflation. The Federal Reserve, our central bank, publicly targets a 2% inflation rate per year to keep the economy healthy. But recently, you've probably noticed inflation is around 3% in the news. This means if your money isn't outpacing inflation, if you're not earning at least 3% when inflation is 3%, your money is actually losing purchasing power just sitting there. Think about the U.S. postage stamp. In 1971, it cost 8 cents. Today, it's 73 cents. The mechanics are the same, but it costs more because of inflation. So, how do we beat it? By investing our money. A common question is, how much can I really make? While there are tons of strategies for passive investors and beginners, the index fund approach is tried and true. As I mentioned earlier, consistently investing in an index fund that tracks, say, the S&P 500 can give you average annualized returns of 8 to 10%. Let's look at a real example. If you earn $70,000 a year, which is around the median household salary in the U.S., after taxes, you'd have about $4,500 to $5,000 per month. Let's say your fixed costs like rent and bills are $3,500. That leaves you with an extra $1,000 every single month to invest into the stock market. Let's also say you have about $5,000 in a savings account that you can start your initial stock market investing journey with. So that's what you do. You put an initial deposit of $5,000 in there, and you're going to be adding about $1,000 per month every single month. The average annual return that we're going to put in is 8%, and the years to grow will toggle this to 30 years. And I want you guys to see the power of the compound interest that's working here. In 30 years, your portfolio balance will be over $1.5 million, and your total investment over time has been $365,000, while your profit is over $118 million. There are two factors at play here. One is that you are consistently investing your money into the markets, and the second is that you're leveraging the power of compound interest and time. Now, on this calculator, you can even play around with different numbers and see what your ending balance is. And you just have to know that when it comes to compound interest, a lot of the gains are going to be towards the end of whatever period you are investing in. So in another example, let's say you're able to invest $2,000 a month this time, and you got the same return. Look at how much more powerful this is. A $3 million ending balance, and you can see that most of the gains are towards the end. The key to investing, then, in my opinion, is continually investing and trusting the process. Now, a quick note on how reliable the stock market is. Of course, you can lose money in the market. Some years are going to be down years. In 2022, for example, the S&P 500 was down close to 18%. And then sometimes in other years, you're going to be massively positive. Like in 2024, the S&P 500 was up 25%. And in 2023, I think it was up around 20% as well. On average, though, you should come to expect the 8% number that so many people like to talk about online. That's typically the average annualized return. I want to show you guys a fascinating example, though, of how time in the market can really just trump trying to time the market altogether. In a blog post on the website of Dollars and Data, which is a great financial blog, by the way, I'm going to link it down below for you guys. The author gives a really strong argument as to why the retail investors should just keep buying. His main point is that, quote, rather than to worry about whether now is the right time to buy, just keep buying. Market high or market low, just keep buying. He points out that as stocks get more expensive, and he uses the P/E ratio to gauge whether or not a stock is expensive, which we will talk about later on in this video. As the P/E ratio gets more expensive, their future returns generally decrease. This makes sense. Like if you buy an overvalued stock, it probably won't return as high as if you got in with a margin of safety. And you can see here that as the P/E ratio increase, so as stocks get more expensive, there's a negative correlation here with your returns for the next 5 years. But here's the fascinating thing. The author, Nick, says that as long as you hold for a longer period of time, watch what happens to your real returns, even if you bought at an overvalued price. Looking at this interactive GIF, you can see that as years pass by, 5, 10, 15, 20, 25, 30 years, the number of red dots decreases. He states that, quote, over any 20-year period, U.S. stocks have had no real negative returns when including dividends, and over a 30-year period, the returns have generally converged despite some dispersion. So that basically tells us that to accumulate our wealth in an aggressive manner, we should just keep buying no matter what. He uses an excellent example that if you were to search on Google, stock market overvalued 2012, many articles will come up detailing what investors believed at that time. They believed that the market was overpriced by 50% in some cases. But look at this graph from the S&P 500. In 2012, it was trading at 1,400, and today it's trading at close to 6,000, if not already over that. If you had believed it was overpriced back then you would have missed out on some serious gains, as 10 to 15 years later, we're pretty close to nearly 3 times that. All right, So now that we've covered that, let's actually go over what is the stock market and what is a stock. So basically, the stock market is just a marketplace that is now all digital. And in this marketplace, people are buying and selling stocks left and right. When you buy a stock, you're purchasing a small piece of ownership in a company, and you're typically buying it from someone that is selling it to you on the open market. Owning a company's stock gives you claim on its assets and earnings, and the stock market allows you as an individual to trade these shares. And the prices of these shares will fluctuate based on factors like supply and demand, how well the company is doing, and its expectations in the future, or share prices just might fluctuate based on broader economic conditions. The stock market, then, is just a system that allows people to connect to one another in order to trade these shares. Now, to quickly explain why companies would even want to sell their shares on the open market. The reason is that companies sell their shares on the open market primarily to raise money for growth and expansion. They like to raise capital, and this process is called an IPO or initial public offering. You might have heard that term before, but basically it means that the company has gone public and sells their shares on the open market, giving a larger pool of investors access to that company's shares, including you and me. And therefore, we can speculate on the price and perhaps the future direction of the company. Now, before I get into how stocks are categorized, which is an important topic that we're covering today, we should go over some of the most important terminology of the stock market so that you can speak the language and understand the lingo. Not only will these terms follow in this video, but you might actually hear it out in the world, or you might see it in the news or on financial websites. All right, so here we go. Bull versus bear. This is something you're going to hear very often in stocks or cryptocurrency or even different markets like commodities. Essentially, being bullish on something reflects that you have a positive outlook on the future of that market or whatever you are speaking about. And the sentiment means basically that you would expect prices to rise in the future. You could be bullish on tech stocks, which means that you think tech will outperform in the short term or perhaps the medium term. You could also be bullish on, say, collectibles like Pokemon cards or perhaps rare video games. Now, being bearish, on the other hand, or a bear, as they like to call it, means that you have a negative outlook on the market and you expect prices to fall. The easiest way to remember the difference between the bull versus the bears is that bulls typically have horns, and the horns point upwards. And that is the direction you want prices to go if you are someone who classifies themselves as a bull. Now, a bear has claws and usually swipes downwards when hunting, right? So, in the market, a bear or bearish sentiment means you expect prices to fall. Easy to remember. Next, a super important term, market cap or market capitalization. This simply tells you the size of a company. If a company has a large market cap, it means it's super valuable and worth a lot. We'll really cement this with an example in our next segment. Then we have indices. We've touched on these before. An index tracks the performance of a group of pre-selected investments like stocks. Think of the S&P 500, NASDAQ, or the Dow Jones. Each one follows a specific basket of stocks. All right, this next one is one of my favorites, frothy. When someone says the market is frothy, it means stock prices and valuations are getting inflated, almost like bubbles rising in a really bubbly drink. It's not quite a market bubble yet, but it's getting close, signaling that things might be overvalued. A full-blown stock market bubble is when prices are insanely inflated due to speculation, leading to an eventual crash, like the infamous dot-com bubble of 2000-2001, where many companies had ridiculous valuations with no real business model. Now let's talk about blue-chip stocks. These are truly excellent stocks. Companies like Apple, Coca-Cola, McDonald's, and Microsoft often fit this description. The term actually comes from poker, where blue chips were the most valuable. It was first used in 1923 for stocks trading at $200 or more per share. On the flip side, a penny stock is typically bought for pennies, usually from a very small, highly speculative company. And finally, for this section, dividends. A dividend is a portion of a company's profit that's paid back to you, the shareholder, just for owning the stock. Companies often reward their investors with dividends, usually paid quarterly, either in cash or through stock reinvestment. Many beginner investors love dividend companies because they offer passive income and are often large, stable businesses. All right, now that we've got some basic terminology down, let's talk about how stocks are typically categorized. I see three main ways: by market capitalization, sectors, or themes. Market cap helps you understand a company's size and risk. It's calculated by multiplying the share price by the number of shares in circulation. We have micro caps, under 300 million, small caps, 300 million to 2 billion, mid caps, 2 billion to 10 billion, and large caps, over 10 billion. Plus, these days, mega caps, like Apple, Nvidia, and Google, are in a league of their own. Micro-cap stocks are usually much more volatile and riskier, but they also offer huge potential upside because they're so small. However, many penny stocks fall into this category, and as beginners, we typically want to steer clear of them. It's really hard to pick the winners, and many can go to zero. Compare that to a large or mega-cap stock. They were much more stable, but might offer slower growth. For instance, it's incredibly hard for a company like Apple, already valued at over $3 trillion, to double its stock price again. That would mean adding another $3 trillion in value. A massive feat. Our next category is sectors. These are just groups of stocks based on their industry focus, like energy, real estate, or information technology, the tech stocks we all know. Having a diversified mix of sectors in your portfolio is generally a really good idea, giving you exposure to different parts of the economy. While some prefer to concentrate their investments, for beginners, diversification is always a helpful strategy. Lastly, we have themes. There are so many themes out there. Think AI stocks, growth stocks, ESG, environmental, social, and governance. Stocks, emerging market stocks, defensive stocks, value stocks, the list goes on. While it's good to have a general idea of these, they aren't absolutely crucial for just getting started. Now, let's talk about what to invest in as a beginner. We'll cover a couple of approaches today. The first is investing in individual companies. This can be super exciting with the potential for high returns, but it's also riskier. Imagine you have $1,000 and invest $200 into 5 different companies. If one of those, say Nvidia, triples in value, your $200 turns into $600, giving your portfolio a massive boost. But the flip side is true too. If one company performs poorly or even goes to zero, your losses could easily outweigh your gains from the overall market. For example, if the market's down 10% in a year, and you're holding some individual stocks that dropped 50%, you're definitely feeling the pinch more than the overall market. The big goal here, especially for beginners, isn't to underperform the market. Why? Because the market, through something like an index fund, is actually the easiest benchmark to hit. If you just invest in index funds, you pretty much guarantee yourself that market return. Now, picking individual stocks can be super tempting. It feels like a fast track to beating the market and building wealth quickly. But here's the catch. It demands a ton of research, a lot of high conviction, and you have to be okay with potentially losing money or seeing your portfolio swing wildly. That's why the second approach, which is way simpler and more beginner-friendly, is just investing in index funds. Think of an index fund like an S&P 500 ETF as a magical basket. With just one purchase, you get a diversified portfolio of hundreds of the top U.S. companies. It's a set-it-and-forget-it passive strategy, letting you ride the market's historical average of 8 to 10% returns over time. Examples? You've got VFIX, or its ETF version, VOO. Ever wonder what those weird letters are for investments? They're called ticker symbols, like airport codes. JFK for John F. Kennedy Airport, LHR for London Heathrow. Companies like Apple, Google, and Microsoft have their own, and so do these funds. Index funds are amazing because they're passively managed, meaning super low fees since there's no expensive fund manager calling the shots. Plus, your money gets instantly diversified across all the holdings in that index. Another cool option is a target date fund. These adjust their asset allocation as you get closer to retirement. So if you're planning to retire in, say, 2060, it'll start heavily in stocks now, then gradually shift to safer investments like bonds as 2060 approaches. These are super common in retirement accounts like 401ks. For most beginners, I'd say either go all in on index funds or maybe put the majority of your money there, and then pick a few individual stocks for some extra upside. Remember, beginner investing isn't about day trading or chasing quick wins. It's about playing the long game. Quick heads up, there are tax implications we'll cover later, but the main takeaway is to build a portfolio that matches your risk tolerance and your goals. Let me tell you a cautionary tale about picking individual stocks as a beginner. Take Intel, a high-flying tech stock during the dot-com bubble. If you had chosen that stock back then, even today, you still wouldn't have broken even on its all-time highs from 2000. Compare that to the overall market, which has grown 425 times since 2000. That's the danger of individual stocks. High risk, but yes, also high reward if you nail it, like with Nvidia. But as beginners, we want consistent, less stressful gains over time. So, now that you have some ideas on what to invest in, let's talk about where to buy them. You can't just use your bank account for this. You need a special account, a brokerage account or a retirement account like an IRA, Roth IRA, or 401k. Brokerage accounts are the most common. Think Fidelity, M1 Finance, Charles Schwab, Robinhood, Vanguard, E-Trade, Webull, Interactive Brokers, just to name a few. For beginners, I personally recommend M1 Finance, Fidelity, and Robinhood because their interfaces are super user-friendly. I'll drop links to them below. Within these platforms, you can open a taxable brokerage account, which is standard, but you can also open retirement accounts like an individual retirement account, or IRA, and its amazing cousin, the Roth IRA. A 401k is usually employer-sponsored, so you set that up through work. I've got another video diving deep into 401ks versus other accounts, which I'll link for you after this. Now, my absolute favorite account to trade in is the Roth IRA. If you only remember one thing from this entire video, it's this. Start a Roth IRA. The benefits are incredible. You put in money you've already paid taxes on, but then all your earnings within that account grow completely tax-free. As of 2025, the contribution limit is about $7,000 per year, but it can change. Here's the power. Imagine you buy Apple stock regularly in your Roth IRA. In 50 years, let's say it grows to $2 million. You wouldn't owe a single cent in taxes on those gains. In a normal brokerage account, you might owe 15–20% in taxes. That's why the Roth IRA is so powerful. For now, just know you need a special account, either a Roth IRA or a taxable brokerage account, to buy these investments. All right, let's move on to researching stocks, a super important part. Investors typically fall into two camps: fundamental analysis and technical analysis. Fundamental analysts try to figure out a company's intrinsic worth, its true value. They dig into things like revenue, profits, cash flow, assets, liabilities, and its market position. By comparing their calculated intrinsic value to the current market price, they decide if a stock is undervalued, overvalued, or just right. Well, they often compare a company's current valuation to others in its industry. Imagine Google, a tech giant, is trading at a much lower price-to-earnings ratio than, say, Nvidia. That could be a strong signal for an investor to buy Google, seeing it as potentially undervalued. This is a very different approach from technical analysis, where traders look for patterns on stock charts and focus on short-term price movements, caring less about the company's core business. Fundamental investing, on the other hand, is about taking a longer-term view. You buy into an undervalued company, patiently hold its shares, and trust that the market will eventually recognize its true worth, leading to price appreciation. It's about believing in the business. Now, if you're thinking, okay, But what specific numbers should I be looking at? I've got you covered. As a fundamental investor, there are 5 key indicators you really want to pay attention to. First up, we have our revenue, net income. Das. Revenue simply tells you how much money the company is bringing in from sales. It asks the top line. Net income or profit is what's left after all the costs are paid. These are your foundational numbers, giving you a general overview before you dive deeper. Next, a big one you absolutely need to know, the price to earnings, PE ratio. We've actually touched on this already, but it's crucial. Many investors use the PE ratio to gauge a stock's current valuation. Think of it this way. If a company's PE ratio is 20, investors are paying $20 for every $1 of that company's annual profit. Generally, a high PE can suggest investors expect strong future growth, while a lower PE might indicate the company is undervalued or just performing incredibly well relative to its past. But here's the kicker. Context is everything. You must compare a company's PE to others in the same sector. Tech companies, for example, often have higher PE ratios than retail companies because they typically have higher growth rates. Always compare apples to apples within the same industry. Let's look at a real-world example from Yahoo Finance. Apple, at the time of this recording, had a PE ratio of 38.37 over the past 12 months. That means investors are happy to pay almost $38 for every dollar of profit Apple generates. A high PE like this often means investors expect strong future growth or see it as a high-quality business worth a premium. Then there's Nvidia, trading at around a 53 PE ratio. This suggests the market is pricing in a lot of growth, perhaps due to its innovation in areas like AI chips. Moving on to our 4th metric, we have the price to sales, PS, ratio. Similar to PE, this is the company's share price divided by its sales per share. This ratio is super useful, especially for companies that aren't profitable yet. If a company isn't making a profit, you can't use PE, right? So, investors use PS to see if the stock might be undervalued or overvalued by comparing it to profitable companies in the same industry. If a promising company has a lower PS ratio than a profitable competitor, it could signal an attractive valuation. But remember, always use this with other metrics for a complete picture. Finally, number 5 today is a free cash flow, FCF. This indicates the cash a company generates each year, that S left over after all its internal and external obligations are met. Essentially, it's the money a company can safely invest back into the business or distribute to shareholders. A positive and growing free cash flow trend usually means the company is healthy and has enough cash to operate and invest. If FCF is trending downwards, it's a red flag you'll want to investigate, as it could point to future stock performance issues. Now, it's worth noting that not all companies are ideal for FCF analysis. Banks, for instance, often have negative free cash flow due to their unique business model, heavy reliance on interest income, and significant liabilities. But for most other businesses, FCF is a powerful indicator. Beyond these numbers, don't forget about soft factors. These are qualitative insights that can really guide your decision. Take Robinhood, for example. In early 2024, it was trading around $15 a share, and many were still bearish because of past negative sentiment. But I noticed some bullish, soft indicators. On Reddit, many users still relied on Robinhood, often sharing screenshots from their app. Plus, Robinhood continued to innovate with new features, a credit card and transfer bonuses, while older brokerages like Schwab and Vanguard hadn't evolved much. The fact that the founder was still leading the company also made me bullish. Founder-led companies often have a unique drive. So there you have it, a blend of hard numbers and crucial soft factors to consider as a fundamental investor. Understanding these will give you a huge advantage in the market. Thanks so much for watching today. If you found this information helpful, please hit that like button, subscribe for more content on building your financial future, and let me know in the comments what other investing topics you'd like us to cover next. See you in the next video.